Good morning, winners. Welcome to Terry's Tips, guys. Today I'm going to give you the secret to getting real estate approvals, guys. And this is all real estate approvals at all levels, okay? So whether you're a first-time home buyer, or whether you're an investor, whether you want commercial financing, guys, there's 3 key factors that you need to understand that can unlock hundreds of thousands up to millions of dollars for you guys, okay? So real quick, who should watch this video? Guys, if you are brand new to real estate investing, a brand new entrepreneur, if you don't own a property, you're just trying to do it as a consumer, this video is for you. But this video is also for my seasoned investors, guys, or my investors that have started to have a little bit of a portfolio, a couple of houses, and you're looking to expand, you're looking to grow. For my bigger investors, if you hit a roadblock, you're getting a bunch of denials, guys, you need to understand these 3 key factors because strategy, sometimes you can change the lender or change the type of financing depending on where you're strong and where you're weak. Get a notebook, get a pen, okay, guys? And real quick, you see it looks a little bit different, guys. So I am in Riviera Maya right now. It is hot, but I'm going to get through this video. And I'm here with 9 to 5 millionaire Jamal King from the Make Real Estate Real Family Reunion, guys. There was a couple hundred people here from around the USA, around the globe, guys. And we're going to be here for a whole week. It's absolutely beautiful, right? And we're doing workshops and seminars and networking and all of these things and having a little bit of fun. But you know, nothing stops my Terry's Tips video, okay? And if you are new, welcome. Guys, my name is Terry. I'm a self-employed entrepreneur, mother, YouTuber, investor, personal and business credit guru, guys. So I upload brand new videos every Tuesday and Thursday morning. So make sure you subscribe if you're looking to leverage your personal and business credit to build wealth. Got it, y'all? So first, let me talk about what I'm going to talk about in this video. So 3 key factors to getting you approved for all types of real estate financing, guys, okay? And then I'm also going to outline some of the differences between the types of lenders and the types of financing. Guys, the success is in the details. Remember that, because a no for one project may be because of the kind of lender or the type of financing. And if you can switch one of those factors, that can turn it into a yes, okay? So first, let me outline the types of lenders, okay? There's 3 big buckets. Write these down. So the first bucket is going to be your traditional lenders, right? Your big banks, your mid-sized banks, even like your credit unions. So some of the pros to the bank is that they always have usually better lower interest rates, lower down payment, much better terms, right? That's one of the benefits of going to a traditional lender. But what is the downside, guys? They want that paperwork to be right. You need to have your taxes, you need to have your verifiable income, you need to have pay stubs, and depending on the type of investor you are and the type of financing, they're going to want a ton of documentation, right? So you can, with traditional lenders, get commercial loans, get conventional loans. You can also get FHA and Freddie Mac and cash out refinances and home equity lines. So guys, when you're going to a traditional lender, you're doing an FHA loan, first time home buyer, you're only going to need 640 credit score, 620 credit score, right? And only zero, anywhere between 0 to 3.5% down, right? So 0 is going to be for your VA loans, your USDA, and your first time home buyer programs, 3%, 3.5%. I'm sorry, guys, you turned on the sprinkler, but I'm just going to make sure that I hope you guys can hear me. I'm going to talk loud, okay? So, and then if you want to use a traditional bank, guys, for your investment property, for a second property, a second home, right? They're going to be, your down payment's going to be anywhere between 15% and 25%, right? Post-COVID is going to vary, but you're always going to have better interest rate, better terms, a lot easier for you to pay back, but they're looking to assess the risk. Guys, write that down. How risky do you look on paper? Because all of the lenders are looking at, do you have the capacity? Do you have the ability? Do you have the track record to pay the money back? Okay, the second type of lender, guys, is hard money. Yes, okay, so us investors, we love our hard money lenders. Pros and cons, guys, okay? So some of the pros are that they're not really kind of strict on paperwork. They're not strict on credit, right? So they will almost give money to, if you have a lot of basic things on paper and have a good project, they will fund you. Now, some of the downsides, right, guys, is there's high interest, high fees, a lot of money down, right? You're going to be paying interest-only payments to your hard money lender. Oh, you can come on. You're going to pay interest-only payments to your hard money lender, while you're doing the actual project. No worries. Guys, look, I'll tell you, this is real time, and people, I'm on the walkway doing the video, and I'm not stopping the video. So it is what it is. So that's the hard money loans, guys. Now, always remember, nugget here, you're only keeping a hard money loan for 6 to 13 months, period. So you're either buying the property, renovating it, and selling it within 6 to 13 months, or you're buying the property, you're renovating it, and then if you want to keep it for it to be a buy and hold instead of fix and flip, guys, then you want to make sure you look good on paper so you can qualify for the refinance afterwards. Guys, that's a big mistake a lot of people are making, is that they qualify for the hard money loan and they want to keep the actual property, but they don't qualify for the refinance. Guys, if you know you want to keep that property and you're using a hard money lender, you must make sure that you still look good on paper so you qualify for the refinance when the renovations are done. That's a tip, guys. Now, another tip right here for hard money lenders. I have seen them approve people at 550, 600 credit scores. Will they sometimes approve you? Yes, but it's going to cost you. So if you are somebody that has bad credit, but a lot of capital, a hard money loan is going to be a way for you to build your real estate portfolio, build your actual empire. Another nugget here, guys, is experience. So for your investment loans, for your commercial loans, for your real estate properties that are going to be buy and holds, you want to build a great big portfolio or rent out to people. Guys, sometimes they want experience too. Write that down. So some of you guys have credit, you have down payment, but then you don't have enough track record. You don't have a big portfolio. You don't have experience, especially for a hard money lender. So sometimes they'll deny you because they're like, this is too risky. They don't know what they're doing. They don't have a track record. If we give them this money, it's not likely, come on somebody, that they'll pay it back. So a workaround, guys, if you do a JV, a joint venture, what that means is that you may have the money, you may have the credit. Someone else may have the portfolio, the background, the experience. Guys, you can go on an LLC together, and then now you've met all those requirements and you can actually qualify. So maybe somebody in your network has the experience that you can partner with. Some of our hard money lenders actually have investors with experience who can partner with you. So that's one of the benefits of being a part of Make Real Estate Real, is because we do everything we can to help you guys have success. Okay, and then the third category, guys, is like private lenders. I'm also going to put fintech companies in there. So guys, private lenders is not like some mystery thing, okay? Private lenders are a lot of times, it can be like, maybe a friend, family member, a mentor, in your network that has capital, right? They're willing to help you invest. It could be for the whole property. It could be for the down payment. It could be for the renovations. It could be to pay the contractor. It could be for different things. Now, something to note right here, guys, nugget, write this down, is that when you're using a private lender, they're probably going to either want to be an equity partner, or they're going to have traditional loan terms. So let me explain. When you have a private party who is going to invest in your project, they are giving you money, right? An equity partner means that they're going to say, I'm giving you $20,000, I'm giving you $50,000, I'm giving you $80,000. And my return, right? Because they're investors too. They're not just giving you money and saying this is a gift, y'all, okay? They want their money back. They're going to say, I want 50%, of the profits, 30% of the profits, 80% of the profits. So what that means is that they're helping you get started. You're going to do the property, do the renovations, but then after that, when you have the actual profits, right, you're going to either split up 50-50 or 40 or 80, whatever terms that you two agree on. Now, traditional terms, right, like a loan terms with a private lender is kind of like, and this is kind of what I do, it could be two different ways, guys. So this is where, let's say somebody, a friend, family member, mentor, whatever, gives you $50,000 for your project. They can say, I want you to pay it back monthly, $1,000 a month until it's paid in full or whatever, right? So that's actual loan terms. Or they can do a one-time lump sum amount, which is what I do. So that means is that this is a private lender now, guys, right? And say they give you $50,000 for your project. And then I'll say, okay, I'm giving you $50,000 for your project. And in 8 months, 12 months, 24 months, 6 months even, I want back $60,000 or $70,000, right? So you know that no matter what, that you owe me $70,000 in 6 months or 12 months or 18 months, okay, guys? So whenever you're using private money, an angel investor, make sure you're super, super clear on the terms and the amount that you're going to pay back, okay? Because it can vary. There's a lot of flexibility there. Like, you guys can actually negotiate the terms, so it's a win-win. It's always supposed to be a win-win, guys. Fintech companies. So guys, this is for business credit. So think about them as private lenders for business credit. They're going to be looking at, do you have a DUNS? Are you incorporated? What is the risk? Are you revenue? A lot of times they want to look at if you have cash flow in your business bank accounts every single month. They're not really looking at taxes and things like that. They want to see, is there $10,000, $20,000, $30,000, $50,000 in your bank account every single month. So if you have revenue, you have strong banking information, even if you're a new LLC, a fintech company can be amazing for you guys, because fintech companies can give you $10,000, $80,000, $100,000, $300,000, guys. They give people lines of credit so you have flexibility. That's another nugget, guys. When you're using fintech companies or you're using private lenders, a lot of times they're just giving you the money. here's 50,000, here's 80,000. What you use it for can actually vary. You can come on. What you can use it for can actually vary. It's not actually tied to an actual property, right? So you can use it for down payment, renovations, contractor. You have that liberty. All right, so I outlined the 3 types of lenders. Everybody's gonna fall into those categories, guys. Traditional lenders, hard money lenders, or guys, fintech companies and private investors. All right, now the 3 key factors, guys, write this down: income, assets, credit. I'm gonna break down every area and the differences. Income, assets, credit. I want you to write those things down and evaluate yourself. So income, they always want to have verifiable income, right? Especially for a bank, they're going to want like W-2s if you're an employee. They're going to want bank statements and 2 years taxes if you are self-employed, right? For hard money lenders, for private lenders, for fintech companies, that is going to vary. I've seen some hard money lenders want at least like 1 year taxes sometimes. That's going to vary, right? So you need to have verifiable income. You cannot be on unemployment. You cannot be on, short-term disability. You cannot just be, like you have to either have a business, guys, or W-2, a business or W-2. Now, another nugget here, guys, is for the traditional lenders. 2 years worth of employment history. Now, say due to COVID-19, right, you were laid off or you lost your job or something of that nature. As long as you stay in the same industry, this is a nugget, guys, you can still get approved. So say you were a nurse for 5 years, okay, and then you lost your job due to COVID-19 and you were out of work for 4 months. And then you found a new job. I'm sorry, guys, it is like hot here. You found a new job as a nurse, right? Like at 6 months later, 3 or 4 months later, different company, different, different kind of, title maybe or salary, but still in the nursing industry, guys. They will count that. They will count that time for you so you can still qualify. What you don't want to do is go into a traditional bank and have 5 years in nursing, lose your job or quit and be out of work for 4 months and then now come back in your CDL driver, because they're going to want 2 years of verifiable income now in that new industry. That's a nugget. Stay in the same industry. Even if you lost your job, even if you resigned, all those things, if you're looking for bank financing. If you're self-employed, they're going to want 2 years taxes usually and 3 to 6 months bank statements, okay? So income, you must have income, because all of the lenders at all levels want to confirm that you have the ability, the capacity to pay the money back. Now, assets, right? Your assets is your down payment money. Write that down. So this is where for traditional FHA like loans, 3%, 3.5%. For hard money, I said 20% to 40%. For like a lot of times the like the commercial loans, the conventional loans for traditional banks, anywhere between 15 and 25%. So depending on how big the project is, 10% of 100,000 is a lot different than 10% of 5 million, right? So understand that the different types of lenders have different types of criteria for assets. It's going to be a percentage of the property, right? Of how much the actual property is. And then, guys, credit. So guys, it varies. So like I said, with the traditional banks, for cash out refinances, I've even been seeing, for cash out refinances, home equity lines, I've been seeing a higher amount, right? So if you're doing conventional, you're doing investment loans, and you're using a traditional bank, you definitely want to be a 680 and above. I've seen some of them want you to be actually like a 720 too. You can come through. You can come through if you need to. A 720, right? So always have a goal for all of them to be a 680 and above, honestly. But if you're doing a traditional bank and you're doing FHA or Freddie Mac, guys, it can go down to 580, 620, 640 is a good benchmark. Okay, so for like the private lenders, guys, and for the fintech companies, it's going to vary very, very widely. They just want to make sure that you have the actual income. And a lot of times they'll still give you the financing, but they're going to make you put more money down, or they're going to make it like a super aggressive interest rate. So pay attention to that. All right, guys, so let's recap, okay? Oh, and one thing I want to add about the hard money lenders. A lot of hard money lenders, most of them will only lend to a business. Remember that. So you need to have an LLC. So if you live in Virginia and you're investing in Chicago, you need an LLC in Chicago, guys. If you live in Virginia and you're investing in Chicago and Pennsylvania, you need an LLC in Chicago, an LLC in Pennsylvania, guys. Because a lot of the hard money lenders will only give money to an actual business, not to an actual person. So even if you're thinking about doing real estate investing somewhere else, guys, make sure you're incorporated. Even in your own state, if you think that you want to do fix and flips, use hard money, or use hard money for buy and holds, get an LLC ASAP. When, Terry? Right now, okay? And you guys also know, as a benchmark, a 680 and above a lot of times unlocks a lot of financing for business credit. Now, nowhere did I say an 800. Guys, you don't, a lot of times the biggest financing, like the best financing package starts at 640 and above. Some are 720. That means whether you're a 640, 650, 720 or 740 and above is usually like the top financing tier, which is what you're trying to actually do, guys, right? So this is where whether you are, a 740, a 750, a 780, that's that top financing package. So don't kill yourself trying to get an 800. The reason why I'm doing this video, guys, is because if you're strong on capital and not credit, you can go to a certain kind of lender. If you are willing to go with a private lender and you have somebody who will lend to you, you want to negotiate those terms, right? If you're going to a bank, you may have really, really good credit, then maybe your avenue is working on your credit because you don't have as much down payment money. So you can be strategic about changing the lender, changing the type of financing based on where you're strong and where you're weak. Got it, y'all? All right, and I want everybody to have a goal of honestly like a 680 and above, but once you're past like a 740, don't kill yourself to get to an 800. The goal is to leverage your credit to build wealth. Whoo, y'all, I got through the video where it's high, it was people walking around, but no, that's not Terry's video, Terry's tips. All right, and for my nugget, guys, you have to get in the environment. Guys, what has been going on here has been nothing short of magical. A couple hundred people from across the nation with all different kinds of goals, financing, credit, all here for the same thing, guys. You cannot pay for, what is going on in the hallways, in the conferences, at the different events, all of the networking, all the collaborations, all of the partnerships. The people who came here, guys, they invested in their future, guys. You have to. If you have not been to a conference, you have not been to a seminar, you have not been out of your state, out of your country to go to a networking event, I highly recommend it, because what happens when you have those kind of conversations with like-minded people is priceless. You want to grow your dream, your legacy, your goals, get in the environment with other successful, like-minded people. Amen? All right, guys, I hope that was helpful for you. Have a super amazing day on purpose, and I will see you on Thursday.